This is David Ranson, and welcome to our client webcast for the month of August 2024. And the subject is explaining US inflation. From a different point of view, in this webcast, we're looking very much about what experience tells us, what it tells us about what is true, but also very much what it tells us that isn't true. And this contradicts a good deal of what economists say about inflation. Beliefs about how the economy works usually come from what people learned in school, or have heard from the press, or have developed out of the economics profession. But it pays to check out the facts. And this is not done sufficiently. Inflation is an example of a major subject about which generally accepted beliefs originate in theory building rather than observation or experience. This webcast reviews several such beliefs, and these are ones that are directly contradicted by empirical evidence. Much of this has been published in past HCWE reports. The theme is observation as opposed to theory. This is a picture of one of the reports we've written on a very contrarian topic, the link between the Fed and the inflation rate, which is not what people think it is. I'd like to start with a positive view of inflation and what is absolutely certainly true about inflation. And we see this in the first exhibit, which plots over a long period of time, something like 30 years, the average inflation rate for a large number of major countries as a function of the rate of depreciation of their currencies in terms of gold. It's quite evident that all of these points lie not very far away from a straight line. The amount of inflation you get is directly proportional to the change in the price of gold, which is another way of saying it's symmetrical with the depreciation of the dollar relative to gold. We can apply this to an even more strenuous, strict test by looking at emerging countries. In emerging countries, we have incredible inflation rates from time to time. Some emerging countries don't have very much inflation. Clearly, the countries that have the highest inflation rates also have the greatest depreciation in their currencies, and therefore the largest increase in the local currency price of gold. This is also over a 30-year period. The numbers involved are so enormous in range, from essentially zero all the way up to an annualized rate of inflation of 100% in the case of Brazil over this particular period. And so we get another test of the relationship, which is more successful in the sense that much tighter relationship than we saw with the developed countries. And that's because we're looking at enormous inflation rates, where factors that affect inflation other than the price of gold drop out as unimportant. And we see here a virtually perfect proportionate relationship between the rise in the price of gold in any particular country and the inflation. But we only get this by measuring all of these data over a long period of time. One other fact about inflation is that it is very, very highly connected with energy prices. the core consumer price index is widely thought to be energy-free. Technically, it's an index of prices excluding those prices of energy and food too, paid by consumers. But it doesn't exclude the effect of energy on the production prices of non-energy goods that consumers purchase. The result is that when energy prices change, they change prices throughout the system, and those prices affect the prices consumers pay for everything else besides energy, and besides food. This chart shows that when oil prices increased by more than 15%, we get high inflation rates, as expected, with this headline CPI, and also, not so expected, a high inflation rate with the core CPI. When oil prices fell a good deal, in the right-hand pair of bars, we get much lower figures for both. It's clear that inflation as measured by the CPI is related to energy prices in a very substantial way, but the core CPI, which people have gotten into the habit of thinking as energy-free, is also closely related to energy prices. So the price of oil, which is kind of a symbol or benchmark for energy prices generally, is very important. And we have to ask what it drives the price of oil. And over a long period of time, we see that the price of gold and the price of oil move pretty much in parallel, just as we earlier saw that consumer prices over a long period of time move in parallel with the price of gold. So energy prices on the average over long periods of time are also proportionate to gold. But in the shorter run, oil prices diverge from the price of gold. We can have a large increase in the price of gold, as we have in the past year or so, without a large increase, without any increase in the price of oil, or with very little increase in the price of oil. That's not a breakdown of the parallel between the two prices. It just means that oil prices have other sources of volatility which come and go. And as we saw in the last graph, over the long haul, oil continues to come back to its parallel with gold. But in the short run, this will be more visible with monthly data. We see big divergences between the oil price and the gold price, which cannot last. And we get back to the same ratio between the two eventually. As we saw in the previous graph, in the first decade shown, the 1930s or so, the early period, the ratio between the oil and the gold price was about the same as it has been in the last decade. So the price of oil is important separately from the price of gold, although it's only temporary. The extraordinary thing is how powerful these two prices are in explaining the inflation rate. Here is strong observational evidence that you don't need a lot of information about the many, many causes of inflation to explain inflation, other than two important ones, which are not actually treated as important by conventional wisdom: the price of gold and the price of oil. You can put together a formula relating the inflation rate In this case, it's the PPI for producer goods. And we find in the dotted line that the actual inflation rate varies very greatly from year to year. And the dotted line, which shows what a very simple formula relating the PPI to the prices of oil and gold can explain of that variation, very great fraction of it. So contrary to popular wisdom, energy prices are a huge factor in the inflation rate, in determining the inflation rate. And we see this even more vividly using monthly data. We get inflation news every month, generally around the 10th of each month. We hear what the inflation rate had been for the previous month, often measured on a month over a year ago month basis. But I'm showing here the month over month inflation rates, the consumer price index in the red line, and the green line is the producer price index, producer goods index. And those two are measured along the right-hand axis. On the left-hand axis, I show the percentage change in the price of oil. And the eye can see there's a very strong relationship on a monthly basis here, which leads to a little bit of forecasting power, because you know what happened to the price of oil in, say, July, when July comes to an end, but you don't know what the inflation rate was until something like the 10th or 12th of the following month. So you can anticipate the inflation news by that short amount of time using this relationship. Another major thesis in conventional wisdom is that inflation is sensitive to interest rate policy on the part of the Federal Reserve. Observation teaches otherwise. The average increase in the Fed funds rate over the last many years has contrasted in this graph with the average cuts in the Fed funds rate. And what we're doing here is plotting the inflation rate that accompanies and follows a change in the Fed funds rate. If the change in the Fed funds rate is positive, we have the red line. And if the change in the Fed funds rate is negative, we have the green line. Now, the widely accepted view, almost universally accepted, is that when the Fed raises the interest rate, it restrains the rate of inflation. And the symmetrical opposite of that view or belief is that when the Fed cuts rates, then there is some acceleration of inflation. Now, this graph takes all of the data back to the middle of the 1950s and averages the inflation impact of Fed rate cuts and hikes. And we see essentially a straight line in both cases. That is, no sign of any restraint on the inflation rate resulting from a Fed funds rate increase, and no acceleration accompanying or following a cut in the Fed funds rate. So the idea that the Fed has the power to restrain inflation is a belief that is not supported by pretty elementary evidence. Another way to see the same point, I've made an emphatic point that energy prices, and especially the price of oil in particular, which is, as I say, a benchmark for energy prices worldwide, is important in determining the inflation rate. And I've made the negative point that the Fed is not important. Well, we can pull those two ideas together to test and let the two potential factors compete to explain the inflation rate. We have here 4 possible scenarios. The Fed can raise interest rates, and we allow here for a year's delay in the impact on inflation. There can also be an oil price deceleration or an acceleration. That gives us 2 possible scenarios. We can also see the Fed reducing the rates over, and again, with a 1-year delay, we can look for the result in 2 possible scenarios, one of which is where oil prices decelerated and the other oil prices accelerated. And then these are the average inflation rates. That's the acceleration in the inflation rate, the change in the inflation rate that results in all of these 4 scenarios. And what you see is in the left-hand corners of this 2x2 table, we see the oil price deceleration as a consistent effect on the inflation rate to reduce it. Whether you use the producer goods index or the consumer price index, that is truly now the case. And you can't see much effect on the core index because it's too small, its movements are too small. If oil prices accelerated, then you get an increase, an acceleration in the inflation rate. And this is true regardless of what the Fed does. If the Fed raised rates the year before, the result is inconsistent. The result is not a reduction in the inflation rate. In general, it can be a reduction in the inflation rate, but it can also be an increase in the inflation rate, and it depends entirely on whether energy prices decelerated or accelerated. It does not depend on the Fed. Same thing if the Fed reduced rates. Another very widespread belief that observation contradicts is the link between geopolitical risk or outbreaks of hostilities in the world and the price of oil. It's widely thought, and many economists argue, that a disruption of supply will raise the price of oil because, of course, disruptions mean supply is cut back, and that makes oil more expensive, more scarce, I should say, and therefore more expensive. And that sounds like good logic, but it doesn't explain what we actually see. We should be looking at oil not as a consumer good, but as an investment asset. And what the observation tells us, and this is one particular example, is the incursion of Hamas into Israel in October of last year. You see here 2 measures of the price of oil, West Texas Intermediate and the Brent price, and it's very clear that any increase that occurred was limited to a few days, perhaps reflecting the belief that there should be a rise. But after the few days, it's a fall in oil prices all the way, month after month after month. This work can be done on many other geopolitical outbreaks of risk, such as the Russian invasion of Ukraine, the assassination of General Suleiman back, I think it was when the CIA sent a cruise missile into Iran. And there are many others, and I've checked them all. In all cases, the evidence is that within a short time, the price of oil comes down and continues to fall for some months after the shock. The risk involved in the oil industry is rather like the risk involved in the stock market. If the uncertainty about future returns from oil increases, then the asset itself, the oil, is less attractive to hold and falls in price. That is a reasonable logic which we take for granted in the case of equities. A rise in uncertainty about the future equity market reduces the price of equities. VIX is a measure of implied volatility and uncertainty in the equity market, so we see an inverse relationship between stock market performance and the change in the VIX index. Here, we're looking at the analog in the oil market. We see here, year by year, these are averages, the change in the oil price and the change in implied volatility in the oil market itself. That's an indicator not as well known as VIX, and that's OVX. And it's very plain that this is the general evidence that when uncertainty goes up, OVX will go up, and that brings the oil price down. And that goes a long way to explain why oil prices have failed to rise in the last couple of years when we've had these enormous geopolitical outbreaks of hostilities and warfare. The oil price has been on the down, has been moving down for a long time, at least until the beginning of this year. And since the beginning of this year, it has been moving fairly much sideways, slightly upward, reflecting perhaps a relaxation of geopolitical risk now that the uncertainties associated with Ukraine and Gaza have lessened. And with that, I'd like to close the presentation and turn to my colleague, David Campbell, who will ask some questions to which I will provide answers as the second part of our webcast.
David, with the November presidential election in the forefront of the news and citizens' concerns, what are the contrasting policies we might expect from a Trump administration compared with a Harris administration?
As is traditional, the Democrats are likely to tighten the regulation of the private sector and increase federal spending. This implies either more taxes or increased debt. A Trump administration would keep personal and corporate taxation down, but increase tariffs on foreign, especially Chinese goods. This would meet retaliation and a downward spiral in world trade.
Would Harris be wise to step back from profligate Bidenomics, and will she?
For tactical reasons, Harris is trying to differentiate itself from Biden. But if there is a difference between them, she is more interventionist and he is more centrist. Biden's government spending was profligate, mainly thanks to COVID relief payments. Harris reached a present position among Democrats on the shoulders of the left. Perhaps now she will shift to the right, but she still advocates major new outlays designed to redistribute wealth to targeted low-income groups.
What is the history of Federal Reserve intervention around presidential elections?
The Fed has long been reluctant to take any action when a presidential election is looming.
You tell us, David, that Treasury and TIPS markets foresee significantly increased CPI inflation. In that case, wouldn't the currently topical potential Fed rate cut be irresponsible?
Yes, but it would be better to let rates be set by the market in any case, in which case future inflation would be priced in.